Let's start by looking at what an optimal capital structure means. It's essentially the right balance between debt and equity that a company uses to finance its operations. This mix is important because it affects the company's weighted average cost of capital, or WACC, which is used as the discount rate for evaluating new projects and investment decisions. For example, if a company has £70 million in debt and £30 million in equity, it has a 70% debt-to-equity ratio. The Miller and Modigliani theorem explains that there's an ideal level of debt that takes into account the tax benefits of debt interest payments, while also considering the risk to shareholders. This risk arises because debt must be paid back with interest before any dividends can be given to shareholders, which can affect the required return shareholders expect. Understanding this balance helps businesses make better financial decisions and create value for shareholders. Now, let's look at the illustration that shows this concept visually. Looking at the capital structure over the period from 2010 to 2020, you can see how equity and debt have been managed. The equity drawn was significant in 2010, but there were no further equity draws after that. Dividends paid increased steadily each year, showing a consistent return to shareholders. The cost of equity is around 14.2%, with equity internal rates of return fluctuating slightly but generally positive after 2010. On the debt side, a tax credit rate gradually decreased from 27.3% to 24%, and the company paid down principal consistently each year. Interest payments and tax saved on interest both declined over time, reflecting reduced debt levels. The cost of debt averaged about 11.6%, with debt IRR nominal decreasing slightly throughout the period. The company maintained a capital structure weighted heavily towards debt at 89%, with equity accounting for 11%. This mix results in a weighted average cost of capital of approximately 11.8%, reflecting the balance between the costs and proportions of debt and equity financing. The illustration breaks down how we calculate the interest and principal cash flows for debt, treating that debt as an investment. We look at the cash flows from principal and interest, after factoring in tax savings, as positive amounts to work out the internal rate of return, or IRR, which represents the cost of debt. Once we have that IRR and the cost of equity, we can calculate the weighted average cost of capital, or WACC. Based on the assumptions here, that rate comes out to 11.8%. From there, we can dig deeper by exploring different mixes of debt and equity to find the optimal debt percentage where the WACC is at its lowest. This optimal point is important because it shows where the company should operate financially to maximize its overall value and the net present value of future investments. To find this point, we consider the different returns investors expect, their risk levels, and the tax benefits from the interest on debt. A practical way to do this is by setting up a two-variable data table in Excel, testing various combinations of debt and equity while ensuring they always add up to 100%. Through this method, we can identify a realistic debt level that minimizes the WACC, ultimately helping us enhance the value of the company's investments.